right? It's Tuesday. It's not 2 o'clock, but it's still Tuesday. So here I am. Today we are going to continue our conversation from last week in regards to rental properties. And as you can see, I have my Christmas tree up. The whole month of December is going to be Christmas themed. I'm sure pretty much everybody's life is like that. So why would I be any different? So last week we kind of started this conversation talking about when you share your own house with a renter. So whether that be a room in your house or a self-enclosed suite, a short-term rental or a long-term rental. So we're going to kind of continue that conversation, talk more about rental properties that you don't live in this week, as well as kind of just dive a little bit deeper on some of the topics. So last week we focused on 4 topics: permits, insurance, taxes, and leases. Today we're kind of gonna skip the permits bit because A, you can watch it in the last week's episode, which is episode 10, and B, unless you are sectioning out parts of the house or doing some kind of major construction to add an addition to your house or like a garage or something like that, you won't actually need a permit. But I will link the entire kind of permits brochure or site for the city of Edmonton. And again, like I said last week, if you're using a contractor to help build, they should be helping you with that permit part as well. Okay, so kind of skipping right to insurance on this one. So again, this week I talked with my friend Sarah at Allstate about some information on this. A lot of the information I did pass on last episode, and it still applies here, but specifically for rental properties that aren't part of your own home, she advised me that Allstate, as an example, can add up to 7 rental properties on your personal insurance policy before it moves to a commercial policy. So that gives you some wiggle room. Also, they want you as a landlord or your property manager, if you use a property manager, to be driving by the property at least once per month. So obviously, if you don't live in the same city as your rental property, then you would probably have to have a property manager. But I would think that a lot of insurance companies are going to have a requirement similar to that. So again, a good idea to check with your insurer to make sure that you can be compliant with what they're wanting. And also, you know, it's not a bad idea to be checking on your rental property that often either, right? Especially like different times of day. So if you always drive by during the day, things might be totally fine. Maybe everybody's at work, but if you drive by at night, it might be a completely different story. So it's just a good idea for you to be protecting your assets as well. Every insurance company has different standards on the age and upgrades of the home. So if you are out there actively looking for an investment property, before you put that offer in or before you make the decision, check with your insurer to see what their requirements are, because if you have to do a whole bunch of renovations just to make your property insurable, that may not fit into what you consider to be a good investment, right? They still, again, Allstate will not insure a short-term rental. So if your plan is to do kind of Airbnb style, your better bet for that would be a brokerage, someone that just carries a lot of different insurance companies, a lot of different products. They can do things that are kind of more outside box. The tenant should always have their own insurance, okay? So not only will your insurer probably require that, but you should as well. So it's a really good idea for your tenant to have their own insurance because it helps protect your asset, okay? If the tenant damages your property because of their neglect, so let's say they overflow a bathtub and they, leave the house or go to sleep or whatever, and that causes a giant flood, your insurance company is going to be able to go after their insurance company in order to mitigate that loss, okay? So that's going to be really helpful to keep you out of a really bad financial situation as well. A typical tenant's policy, and also it covers their property, covers their contents, so it's a bonus for them as well. And a typical tenant's policy is like $250 a year, so it's super affordable, and it just everybody should have one. Okay. Same as last week, talk to your insurer about their pet policy so you can make sure that your lease agreements are matching up with what your insurer will allow. If you are moving out of your principal residence and changing it into a rental home, let your insurance company know ASAP, okay? It becomes a completely different type of risk. So that is definitely considered something that would be a deal breaker if you didn't disclose that information to them, okay? Okay, let's move on to profitability. This is my favorite subject. It should be yours. When you're looking at a potential investment property, or you're thinking about converting your current home into a rental, you want to seriously consider the profitability of the property, okay? Like that should be your main concern. If you're stuck in a situation where the house won't sell, so you're like, well, I just have to get somebody in there. Obviously in that situation, some income is better than none. But if you're specifically looking to invest in real estate, your goal should be to turn a higher profit than you would be if you were just going to invest that money into stocks or mutual funds or something along those lines. Otherwise, why bother with the hassle, right? Like if you have this amount of money that you want to invest, unless you're going to make, you know, a good 20% on it in a real estate endeavor, why not just go with a stock? Because a stock isn't going to call you at 3 a.m. because their hot water tank is leaking, right? Like being a landlord, it's more than just passive income. There is work and due diligence involved. There's this rule of thumb when it comes to real estate investing that they say you should be striving to make 1% of the purchase price of the house in monthly rent. So for example, if you bought a $300,000 house, the market rent for that house should be $3,000 a month. I'm not sure that the market in Edmonton right now works for that formula. So I'm going to kind of look at, I prefer to look at a deeper kind of calculation anyways. So my calculation that I would think would be good would be take all of your house expenses. So that would be obviously your mortgage, your property taxes, your insurance, put in a repairs and maintenance allowance in there, okay? And that's going to vary a lot based on, I don't know, I'm not sure why the video is getting so dark, but hopefully you can still see me. That's going to vary a lot based on the age of the house, how handy you are, you know, how big the house is. Like it's going to depend a lot on that repairs allowance, but make sure that you are including that in your expenses, okay? Estimate that as best as you can. And then, so you have all of your expenses listed out, add 20%, so that's your profit. Okay, and then divide it by either the month, like so divide it by 12 or divide it by 365, depending on if you want to rent it monthly or you want to rent it by the day, okay? So if you're looking at a house and you do that calculation and you're like, well, there's no way I could charge that amount of rent for that house because it just isn't market rent in that area, then that's probably not the greatest investment for you, okay? So that's kind of your litmus test for if this is a good investment or not. I mentioned this last week, but a good way to check out the market rent in the neighborhood that you're looking in is to look at the website rentometer.com, or you can check like Kijiji or Rent Faster for similar size houses in that neighborhood, okay? The other thing that I want to talk about in this video was, and this would apply to anybody who's renting to somebody in their house, maybe even more so because you're sharing the accommodation with a tenant, is how to screen a tenant in order to hopefully minimize your risk and maximize your profit, right? In real estate investing, evicting a tenant is super time consuming, costs you a lot of money, very stressful. So it's something that you kind of want to avoid at all costs. Obviously, it's never going to be perfect. You could literally rent the most perfect tenant and something could still happen. So there's always going to be that element of risk. But if you can minimize it to the best of your ability, that's just good business practices, right? So avoiding, eviction at all costs, very important. Of course, I have some tips for you. So include your deal breakers or your requirements in your actual ad. So for example, if you're not going to allow pets, put that in your ad. This is going to save you time. It's going to save the applicants time. They're not going to bother applying if they know they have 3 dogs, right? Okay, be careful with your requirements though, because there are laws against discriminating against tenants, okay? So last week I linked the entire Alberta Tenancies Act, which includes this information, but today I will specifically link some information on what is considered discriminatory as a landlord. So for example, as a landlord, you can ask about how much their family income is, but you're not allowed to ask about source of income. So you can have the requirement that somebody's family income be 5 times the amount of rent, for example, but you can't say, I'm not renting to you because you're on AISH, okay? That's against the law. Also, you can't discriminate based on ethnicity, marital status, religion, sexual orientation, etc. Okay, I will link this information for you guys, but just so you know, be careful what you put in ads. When it comes to the actual application process, I typically, in most areas of my life, am a very big proponent of email and text messages, but in this case, I would say talking to somebody on the phone, or even better yet, in person when they come to view the property is a great time. It's gonna give you, you can read a lot about a person in between the lines, okay? So if they're only communicating with you via email or text, they can look a lot better on paper than they would face-to-face conversation, okay? So if they show up and they open their car door and a ton of fast food wrappers fall out, like that's probably a pretty good indicator of how they're gonna treat your property, right? Okay, the next step would be references. So prior landlords and employers, if possible, Google this person. Like, I know it seems a little intrusive, but you are trusting them with probably one of the biggest investments of your life. It's going to be literal gold for you to be able to know what their prior relationship with their old landlord is, okay? Because someone could look perfect in every single way. You call their landlord and they're like, do not rent to this person. You should probably take that on board, right? On the flip side, you might pull their credit bureau and see that they have terrible credit history, but if you've talked to their landlord and they say, you know what, they always made rent a priority, they always paid on time, then maybe, you know, that tenant is still good for you, okay? If somebody has no prior renting history, so for example, a student or a new immigrant, you could consider getting a co-signer, like a parent or like their sponsor or a family member, someone that you can call on if the rent isn't being paid or there's significant damages, okay? That can help you not have to say no to a tenant just because they have no prior history. Once you've done all of that free work, like it obviously takes time, but it doesn't cost you money, reference checking, interview, etc., then I would strongly consider pulling a credit report. So this can tell you if an applicant has a lot of debt or has been defaulting on loans. That can tell you what your financial relationship with them is probably going to be like, right? Now, if you've, again, I've talked about talking to a landlord is an important piece of that puzzle as well. Like I'm not saying just because someone has a low credit score, they wouldn't be a good tenant. That's definitely not the case. It's just a part of the puzzle. You have to look at the big picture. The reason that I say this should be the last step is because pulling a credit report, depending on what kind of avenue you go down, can cost you money. So if you've already know that you are feeling wary about this person and this person isn't maybe the best fit for you, then just why bother spending that money to pull the credit report, right? Again, I'm kind of all about that profitability, and sometimes that means being a little bit frugal, right? If you do spend the money, keep the receipt because it's a tax deduction. There is a service that does all of these checks for landlords. I did some research on this. It's called Neighborly. I'll link it later. They're basically a company that's teamed up with Equifax. They do a whole tenant screening process from like basic credit report, like just like their credit score, to all the way like you can do a criminal record check on a person. So they take care of the application process because you do have to have certain disclaimers and things like that on your application in order to allow you to legally pull these reports on somebody. And some of the reports are actually free, so they don't actually cost the landlord any money. And the way that they make their money is they then turn around and offer the tenant insurance. So it's kind of like a win-win situation for everybody. Anyways, I will link that for you later to check out. This brings us to taxes. So again, we did talk about this last week quite a bit, but I just wanted to mention again, rental houses are a taxable asset, okay? So that means that if you sell them for more than what you originally bought them for, you will pay capital gains on the difference, okay? So it's important when you buy the rental, or if you convert your house to a rental, like your principal dwelling to a rental, that you're recording the purchase price or the value of the house the year that it converted, okay? We will use that later when you sell the house as your adjusted cost base, okay? As far as recording the rental income, again, very similar to last week's video. The only extra tips that I would have is that if you own more than one rental property, I recommend tracking your income and expenses separately for each property. This is just going to give you a better view of which property is doing better for you. Again, I will link my handy checklist that I have on my website that shows all the information to record, and please check out episode 10 for more details. There are 2 expenses that I did not mention last week that may be relevant to people who have rental properties that they don't live in. So the first one would be travel. So I touched on this in episode 3, the vehicle expenses episode, but the gist of it is you keep a kilometer log for every time that you make a trip that is what is considered deductible, okay? So the definition of a deductible trip is different for different scenarios. So basically, if you own one rental property, you can only use trips that are relating to maintenance and repairs of that property, but you're not allowed to claim trips to collect rent or for general property management, so that monthly drive-by. If you own 2 different sites, so not like 2 apartments in the same building, but 2 actual different properties, you can claim rent pickup and general property management trips, which would include your inspections, your laundry coin removal, and all that jazz. This also applies if your rental property is so far away that you have to take a plane or a bus. So if you have a rental property in a different city and you need to go and check on it once a year, or go and do some repairs, you would be able to claim the travel expense of that. So keep those receipts. The other expense that you may come across with these kind of rentals is property management fees. So if you choose to use a property manager, which in some cases you might have to, in other cases it just may make your life a lot easier, but again, please make sure that you're still profitable when you're using them. The fees are deductible against your rental income, so again, keep those invoices. And that is it for today. So next week, I will show you how to do a quarterly business review. So I'll show you how I do mine. I'll give you some tips on how you can do yours like a boss. And we'll just kind of, small business owners unite on that. So have a wonderful week, and I look forward to seeing you next time.